Hello, everyone. This is Michael Klein with MPK Advisors and CPAs. And today we'll be discussing the differences between the standard and itemized deductions. This is not specific tax advice, and to our client, if you have or would like a consultation regarding any of these deductions or matters related to the deductions, please let us know, and we'd be happy to schedule that. But it's more for informational and educational purposes. So the differences between standard and itemized deductions, you probably heard the term standard and itemized deductions before as you're preparing your tax returns. And back in 2018, there was a major change in the standard deduction, and it basically doubled. And so federally, we have a very large standard deduction, which historically has been larger than ever before. So many or fewer people are itemizing their deductions as a result. But the standard deduction is like a freebie. You get to take this flat amount. And for 2024, the standard deduction for single filers is $14,600. And for married filing joint filers, the standard deduction is $29,200. For 2025, that amount increases with inflation as it does every year. And that amount is $15,000 for single filers and $30,000 for married filing joint filers. And the difference between standard and itemized deduction really comes into play when you're considering whether you have enough itemized deductions that exceed those flat standard deduction amounts. And so you need to consider whether you have enough to do that federally. But another concern that we often tell our clients is not to forget that the state level does not conform to the federal standard deduction threshold. So often we see people who do not itemize federally, but they may itemize in the state because states do not conform typically. And if you're in California, like we are in our firm, the standard deductions are about one half of that of the federal deductions. And so many more people itemize at the state level. So we encourage our clients and those listening to consider your itemized deductions. Even though the federal thresholds are very high, you may itemize in your respective state. So I'll start this part one with the medical deductions and the state and local income taxes. And in part two, we'll continue our discussion on with the rest of the major itemized deductions. Medical deductions include things like prescriptions, out-of-pocket prescriptions that you purchase at, say, CVS or Walgreens or other drugstore. As long as they are prescribed and diagnosed for a medical condition, you can deduct those out-of-pocket expenses for prescriptions that are not covered by insurance, and those are often called copays, which include doctor copays, hospital visit copays. Those are typically deductible as medical expenses. You can also deduct insurance premiums. So those are premiums that are not pre-tax. So you can't deduct if you have a group qualifying plan like a Section 125 plan at work. Typically, those premiums you pay through payroll are not deductible on your Schedule A, it's called, where these itemized deductions show up, because those are already pre-tax, so they're not taxed, and so you can't deduct them. But if you're self-employed or you're an individual who doesn't have a group plan at work and you're just purchasing your own separate insurance, health insurance policy, typically you can take those insurance premiums. That also includes things like medical equipment and medical mileage. So there's a reimbursement rate every year the IRS sets, and it changes year to year with inflation for the medical rate. So track your mileage as well to and from doctors. State and local income taxes. So those are everything from your property taxes that you pay on your personal residence or investment property, to DMV fees, to also state taxes you pay, things like sales tax or state income tax that you pay through withholdings, through your W-2, or estimated payments. Now, this is a very hot topic today. You probably heard it in the news, also called the SALT limitation. This is up for debate, and in 2025, we expect some new legislation to potentially address the $10,000 federal cap on the SALT deductions. And so we're looking forward to seeing what takes place there. But currently, your SALT deductions in this category are limited to only $10,000. And so you lose everything in excess of that. But we're hoping for some new news soon on this topic.